Episode number 4, deferred delivery. Okay, so now we're getting into the understanding of some liquidity concepts, and like I said in the introduction, I'm giving you guys a liquidity masterclass here. Okay, very few people understand this concept right here of deferred delivery. Okay, some of you have probably never even heard of it. Some of the advanced students have also never even looked at liquidity, how we're going to look at it here. Okay, this is what I call deferred liquidity. Okay, what is deferred liquidity? This is a signature in price action when the market deviates from its path, right? It's drawn liquidity into the opposing direction for a period of time to run stops. We can anticipate this beforehand when the market is at high resistance liquidity run levels. When bullish, the highest up close candles at a level of high resistance liquidity will be used to defer the delivery down below sell stops before the market continues higher with a low resistance liquidity run. When bearish, the lowest down close candles at a level of high resistance liquidity will be used to defer the delivery above buy stops before the market continues with a low resistance liquidity run. Okay, so here's a diagram of deferred delivery. Okay, so we know that failure swings, right, are low resistance liquidity run, trend lines, relative equal highs and lows, right? We go above this high, okay, example. We trade through low resistance liquidity with speed, right, with low resistance. Market retraces, then trades down into a level of high resistance liquidity. This is high resistance liquidity. Why? Because it has gone below accumulated stops and confirmed an order block here. When the market trades into the order block, right, at a level of deferred liquidity, it's going to deviate, right? This is what deferred liquidity is, right? It's deviating from its path, right? It's drawn liquidity down here at a level of high resistance liquidity. You anticipate this to happen at the order block, okay? And then you look for the market to seek opposing liquidity. So buy stops when you're bearish, it runs that, and then it goes back down. So you're going to be able to anticipate this if you apply this, okay? So a bearish, bullish example. Low resistance liquidity here gets run through easily. We retrace, start to expand higher where we're noting this. Now, when you're at a key level here, okay, and you're expecting the market to have a reversal, okay, that lowest low, everything to the left, right, in market maker buy and sell model terms, everything on the left is the sell side of the curve, everything on the right is the buy side of the curve. You want to look at areas of the curve, right, on the sell side of the curve where buy stops have obviously been accumulated. Okay, at that point here, the highest up close candles are going to defer the delivery below a short-term low before running up high. Example of this, the market is in a dealing range here. We have a discount low to premium high. The market retraces down into a discount key level by this fair value gap, and then we start to trade higher here. Okay, and the market looks like it's obviously reaching for this high. But notice here, this high is extremely high resistance. Why? Because it runs stops multiple times. Okay, so this is an area of high resistance liquidity. Now, if we drop to a lower time frame, the highest up close candle, right? If this is a level of high resistance liquidity, the highest up close candle is going to do what? It's going to defer the delivery where below a short-term low when you're bullish to then run up through the high. So we reach an area of high resistance liquidity, the highest up close candle. Now we anticipate, right, a short-term low to get run out. So this is what you should start anticipating in your charts when you see this. Start looking for those sell stops when you're bullish, right? When we hit an area of high resistance liquidity. The market then defers its delivery below the sell stops. Once it's deferred its delivery below the sell stops, it engineers more liquidity above these highs here. So the reason it does this, right, because so many stops have been run here, okay, it needs to do this deferred delivery to engineer more liquidity, because now you have this high and this high, making this relative equal highs, low resistance liquidity now. So it goes from high resistance here. When it defers delivery, it becomes low resistance, and what happens next is from a key level below those sell stops, bang, then it becomes low resistance liquidity again, right? This is going to really help you guys because a lot of people don't understand this, right? And you could be trying to trade some kind of PD array here, right, at a level of high resistance liquidity, but it's not going to use that. It's going to seek a low because it needs to grab more sell stops and engineer more buy stops. And once it's grabbed those sell stops, it will then attack the buy stops. Okay, example here. You can see here, we've had this low run, okay, accumulated. Then we closed above the up close candles, down close candles, sorry, confirming that as an order block. Now the market's hit a key level here. It's gone above daily highs. We had SMT here, fair value gap formed. We're respecting the fair value gap and we trade down here. Now, if you were looking at this chart in live time, and notice we're approaching the AM session. If you were looking at this market in live time, what would you be expecting here? Okay, you'd be looking at this, oh, well, we've respected this fair value gap here. So I'm going to go short, you know, in a lower time frame for a value gap here, right? It doesn't need to come back up here because of the respect of this fair value gap. This is how you get wrecked when you don't understand deferred liquidity. Now we have traded into the lowest down close candles at a level of high resistance liquidity. Where should your eye go now once you understand this concept? It should go to the buy stops, okay? Market then defers its delivery with this move up. When it does that, it's going to grab more liquidity and it's engineering more liquidity, relative equal lows now. And that's what happens next. It turns into low resistance liquidity, right? So anybody who was trying to short in here, or anybody who was trying to short in here because of the respect of this fair value gap and got wrecked here with this move up, it's because they don't understand deferred delivery and these high resistance and low resistance liquidity run concepts.